The bank was nationalized. How did this happen? More than $100 billion of value vanished. A risky takeover decision. Shareholders wiped out. The trigger was two folders. RBS began as a regional Scottish lender. Under Fred Goodwin, it became a global powerhouse. The fact: the bank measured success by size and market share. The consequence: strategy shifted from steady margins to dominance through acquisition. The human impact: traders and executives celebrated growth as proof of genius. In 2007, RBS joined a consortium to buy ABN Amro. The fact: the acquisition was approved after only 2 folders of due diligence. The consequence: a huge leveraged bid committed the bank to short and long-term obligations before full risks were understood. The human impact: the boardroom felt pressure to win. Careers and reputations were on the line. Immediately after the bid, markets cheered. The fact: RBS briefly achieved the scale it sought, and the share price rose. The consequence: management felt vindicated and doubled down. The human impact: bonuses and celebration reinforced the belief that the gamble had paid off. Early post-deal work raised problems. The fact: audits and market indicators flagged complex integration issues, poorer asset quality inside ABN Amro, and rising exposures to risky credit. The consequence: capital cushions began to thin as provisioning needs appeared. The human impact: mid-level risk officers raised alarms and were overridden. First write-downs followed. The fact: RBS reported initial losses tied to ABN Amro assets and growing subprime exposure. The consequence: profits were dented and investor confidence wobbled. The human impact: hiring was frozen and the first layoffs began. Credit markets then tightened. The fact: banks with large wholesale funding needs faced sharply higher short-term costs. The consequence: RBS struggled to refinance maturing debt and relied on emergency liquidity. The human impact: treasury teams worked around the clock to keep the doors open. Losses accelerated. The fact: toxic assets forced massive write-downs across the sector, and RBS's capital ratios plunged. The consequence: market access closed, and counterparty trust evaporated. The human impact: shareholders saw value collapse, staff faced cuts, and pension fear. Global shock arrived in 2008. The fact: the collapse of Lehman Brothers and the ensuing panic froze markets worldwide. The consequence: RBS could not raise the capital it needed privately. The human impact: the UK government stepped in with a rescue that became de facto nationalization, committing tens of billions to stabilize the bank. The turning point was the ABN Amro liabilities proving irreversible. The fact: the acquisition had left RBS simultaneously illiquid and undercapitalized amid a global freeze. The consequence: no private solution could plug the hole, and nationalization was the only viable path to keep the system functioning. The human impact: Fred Goodwin was stripped of leadership, reputations were ruined, and the public watched a national champion fall. Losses exceeded $100 billion when guarantees, recapitalizations, and long-term write-offs are counted. The consequence: shareholders were reduced to near-zero value, and taxpayer exposure ballooned. The human impact: communities and small businesses faced disrupted credit, employees lost jobs, pension holders faced uncertainty. Forensic audits and public inquiries later identified a mix of hubris, governance failure, flawed incentives, and inadequate due diligence. The consequence: regulators and politicians demanded change. The human impact: the public demanded accountability for a national bill carried by ordinary taxpayers. Regulatory overhaul followed. The fact: new rules raised capital requirements, introduced regular stress tests, and enforced stricter controls on large, complex acquisitions. The consequence: the banking industry restructured how it measures risk and how boards approve deals. The human impact: some jobs and business models changed permanently. Executives faced new limits on aggressive expansion. The two folders remained the emblem of the failure. The fact, a single deal, approved with minimal review, exposed the bank to risks that multiplied under stress. The consequence, an irreversible chain of events that turned ambition into collapse. The human impact, families lost savings, shareholders lost fortunes, and a national symbol lost its independence. Stay with this story. Origin matters. RBS's rise, incentives that rewarded scale, and CEO-driven deal-making created the conditions for the ABN Amro bid to overwhelm ordinary controls. Prior warnings from internal risk teams and early losses were present but were not sufficient to stop the escalation. Key decisions, the rush to bid and the acceptance of thin due diligence, directly produced the vulnerability that the 2008 shock exploited. The escalation moved step by step from initial write-downs to funding stress to systemic crisis. The immediate consequence was government rescue. The institutional fallout was years of inquiry, new rules, and weakened public trust. The long-term impact reshaped how large banks are regulated and how boards must approve major acquisitions. Every stage increased risk. Each consequence outpaced the previous one. Small write-downs became funding crises. Funding crises became insolvency threats. Insolvency threats required public capital. The human cost rose with each step. A single decision changed everything. The two folders that approved a massive acquisition did not contain the answers the bank needed. The result was nationalization, a hole of more than $100 billion, ruined careers, and long-term economic pain for citizens. A former employee remembers the day the deal closed and the mood in the trading room. A small business owner remembers calls that went unanswered as credit lines tightened. A shareholder family remembers savings that were worth far less the next year. A nation remembers that a private gamble became a public burden. The lesson is stark and simple. Ambition without thorough evidence can destroy institutions. Leverage makes decisions irreversible. Governance must force full review, not shortcuts. Risk officers must be heard. Boards must demand complete files, not two folders. A single decision cost us our bank, our savings, and our confidence. Learn the warning signs.